Joining me now to discuss Key Advisor Group CEO Eddie Ghabour, along with Neuberger Berman Senior Tech Analyst Daniel Flax. Hey, Eddie, guys, before we get into some of these ideas, I want to discuss this market, this rally. It looks pretty good, you know, considering where we've been, right? But here's something folks need to understand. At the top 20 sessions in history of NASDAQ, 16 times we had these huge moves. We were still in a bear market. So, Eddie, I mean, how do people know, like, okay, is this the turning point? Is there a magic way to know this, or you just need a series of these kind of days?
No, there's no magic equation to figure out whether today is the day. You know, obviously, you need a lot more than one day. Me personally, I think this is another head fake because I think the second quarter is going to be the most challenging because of the weak economic data that's going to come in. The other thing is looking at the VIX. I need to see a VIX much lower than 30 before I have conviction to go back into some of these risk assets. But I do think there's going to be some amazing opportunities potentially in the third or fourth quarter of this year. It's just not right now for our clients.
So, Eddie, you've been spot on with you know, your cautionary approach to this market. But I know last time we spoke, it felt like you were starting to pick some spots. Are you looking at certain areas now where maybe you've begun to nibble?
So we actually today, we bought some more bond proxies. I think right now with the 10-year, right before I got on your show, it had just went back over 2.15. We are non-consensus in our interest rate call. We think that the economy is going to be slowing down faster than consensus, and we think the 10-year bond is actually going to be going down. And I wouldn't be surprised to see it hit that 1.7 mark again. We just got to get through this rate hike that we'll probably get tomorrow. So in our opinion, the best upside here over the next 3 months are going to be in your bond proxies.
Wow.
They're not the sexiest things to buy, but if you get that 10-year bond start to go down, you know, you can get some good alpha in your portfolio because, again, I think with growth slowing has a bigger factor on these growth stocks than the actual 10-year bond. So I'm going to be patient here. I think this next quarter is going to be tough, but after that, I'll start going into those higher risk assets because I think they'll be much lower.
Well, I got to tell you, that's a gutsy call. I'm glad you made it here on the show. Hey, Eddie, I got a minute to go, less than a minute, but we haven't brought up the Fed at all. It seems like you and Dan are sort of looking beyond this rate hiking cycle. What's the greatest near-term risk, or do we know it all? Are there any potential surprises out there?
So, I mean, a big risk would be if they surprise and increase by 50 basis points. I don't think they're going to do that. But the bigger risk, in my opinion, is if they really raise rates 6 times or 7 times like the bond market is pricing in, I don't think there's a doubt we're going to be into a recession and a pretty ugly market. I don't think this market could handle more than 2 rate hikes. Because when you look at the yield curve right now, it's already really flat. And again, GDP, I believe, is going to come in well below consensus. So Eddie, that's the biggest risk.
I'm with you. I think 6 is outrageous. Won't happen. Eddie, Daniel, thank you both very much, and we'll be right back.